Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afiq bin Muhammad, and this is my assignment for FIN435 Financial Market and Banking Services. This is my individual assignment infographic. Okay, let me start with key component of money market in Malaysia. The money market is a segment of financial where the short-term borrowing and lending of funds occur. It provides a platform for participants to trade in highly liquid and low-risk instruments. Various components of instruments are traded in the money market, including treasury bills. These are short-term debt obligations issued by government to finance their short-term funding requirements. These are considered to be virtually risk-free and have maturities typically ranging from a few days to 1 year. Commercial paper CP. CP is an unsecured short-term debt instrument issued by corporations to meet their short-term funding needs. It usually has a maturity ranging from a few days to a few months. CP is typically issued at a discount to its face value and provides higher yields than T-bills. Certificate of Deposit (CDs). CDs are time deposit offered by banks and financial institutions. They have fixed maturity date and offer a fixed interest rate. CDs are considered to be safe investment as they are issued by the government up to a certain limit. Repurchase agreement (repo). Repo transactions involve the sale of securities with an agreement to repurchase them at a later date. It is a short-term collateralized borrowing arrangement with treasury securities often used as collateral. Repos are commonly used by financial institutions to manage their short-term liquidity needs. Debtors protectors (DAs). DAs are short-term instruments that arise from commercial transactions. They are typically used in international trade to facilitate financing of goods and services. DAs represent a bank unconditional promise to pay a specified amount at a future date. Money Market Fund (MMF). MMF are investment vehicles that pool money from investors to invest in short-term, low-risk instruments. They aim to provide stability of principal and liquidity. MMF invests in a diversified portfolio of money market instruments, providing investors with a convenient way to access the money market. This component of the money market provides avenues for investors and institutions to manage their short-term funding requirements, invest excess cash, and earn a return on their fund while maintaining liquidity and minimizing risk. Now let's move to primary function of the money market in Malaysia. The money market serves several important functions in the financial system. These functions include short-term financing. The money market provides a platform for borrowers such as government, corporations, and financial institutions to obtain short-term financing to meet their immediate funding needs. It allows them to borrow funds for a shorter duration, typically ranging from overnight to a year, at competitive interest rates. Liquidity management. The money market helps financial institutions, corporations, and individuals manage their short-term liquidity requirements. Surplus fund can be invested in money market instruments, providing a relatively safe and liquid investment option. These instruments can be easily bought or sold with minimal transaction costs, allowing investors to access their funds quickly when needed. Price discovery. The money market price plays a crucial role in determining short-term interest rates. The supply and demand dynamic of money market instruments such as CDs and commercial paper help establish the prevailing interest rates in the market. This rate in turn influences the pricing of various financial products and impact the overall cost of borrowing in the economy. Risk management. Money market instruments such as CB and high-quality CP are typically considered low-risk investments. They provide a means for investors to park their funds temporarily and preserve capital while earning a modest return. By investing in money market instruments, investors can mitigate the risk of holding more volatile assets or maintain liquidity in uncertain market conditions. Interbank lending. Financial institutions engage in interbank lending in the money market to manage their short-term funding requirements. Banks with excess funds can lend to banks in need of liquidity through instruments like repurchase agreements. This facilitates the smooth functioning of the banking system and helps maintain overall stability in the financial market. Central bank operation. Central banks often use the money market as a tool to implement monetary policy and manage liquidity in the banking system. They conduct open market operations, buying or selling government securities in the money market to improve the level of reserve in the banking system and adjust short-term interest rates. Overall, the money market provides a vital infrastructure for short-term borrowing, lending, liquidity management, and risk mitigation in the financial system. It supports the efficient allocation of funds and helps ensure the smooth functioning of various sectors of the economy. Money market instruments used in Malaysia. In Malaysia, the money market offers various instruments that facilitate short-term borrowing, lending, and liquidity management. Some of the commonly used money market instruments in Malaysia include Malaysian Treasury Bills (MTB). These are short-term debt securities issued by the Malaysian government through Bank Negara Malaysia. NPVs have maturities ranging from 3 months to 1 year and are used to finance the government's short-term funding requirement. Negotiable Instrument of Deposit (NID). NID are short-term negotiable instruments issued by commercial banks in Malaysia. They represent a deposit and are typically issued at a discount to their face value. NIDs have maturities ranging from a few days to several months. Malaysian Islamic Treasury Bills (ITBs) are short-term Islamic securities issued by the Malaysian government. They follow Sharia principles and are used for short-term financing. ITBs are issued through Bank Negara Malaysia and have maturities ranging from 3 months to 1 year. Bankers Acceptance (BA). BA are widely used in Malaysia for trade financing. They are short-term financing instruments that arise from commercial transactions and represent a bank unconditional promise to pay a specified amount at a future rate. BAs are commonly used to facilitate international trade transactions. Malaysian Government Investment Issue (NGII). NGII are short-term Islamic securities issued by the Malaysian government. They are based on Sharia principles and provide an avenue for investors to invest in short-term government securities while complying with Islamic financial principles. Main participants involved in the Malaysian money market. Bank Negara Malaysia. BNM is the central bank of Malaysia and plays a significant role in the money market. It acts as the regulator and supervisor of the market and formulate and implement monetary policy. BNM issues money market instruments such as Malaysian Treasury Bill and manage liquidity in the banking system. Commercial bank. Commercial banks are major participants in Malaysian money market. They actively engage in short-term lending and borrowing activities to manage their liquidity needs. Banks provide funding to each other through interbank lending transactions, including overnight lending and money market placement. Corporation and financial institutions. Corporation and financial institutions in Malaysia participate in the money market to manage their short-term funding requirements and invest excess funds. They, they may issue money market instruments such as commercial paper or engage in short-term lending through instruments like BA. Money market fund (MMF). MMF are investment vehicles that could come from individual institution investors to invest in the money market instrument. MMF provide investors with a convenient way to access the money market and gain exposure to short-term, low-risk instruments. They play a critical role in providing liquidity and stability to the money market. Government institutions and agencies. Various government institutions and agencies in Malaysia participate in the money market. These include entities such as Employee Provident Fund (EPF) and Government-Linked Investment Companies (GLICs). They invest surplus funds in money market instruments to generate short-term return while maintaining liquidity. Now let's move to the framework that governs the money market in Malaysia. BNM. BNM is central bank, formulate and plays crucial role in regulating and supervising money market. It formulates the implement monetary policy, issue money market instruments such as MPV and manage liquidity in the banking system. BNM set the guideline and regulation for the operation and participant in the money market. Securities Malaysia Commission (SC). The SC is the regulatory body responsible for overseeing the capital market in Malaysia, including money market. It regulates activities related to the issuance and trading of money market instruments, including CP and ICP, Islamic Commercial Paper. The SC ensures compliance with disclosure requirements, investor protection and fair market practice. Guidelines and circulars. BNM and SC issue guidelines, circular and regulations that govern various aspects of the money market. These include rules on the issuance and trading of money market instruments, disclosure requirements, market conduct, risk management, and prudential regulation for financial institutions participating in the money market. Now I will explain about capital market in Malaysia. Recent trends and factors affecting performance. Recent trends in the Malaysian capital market. Recovery from the COVID-19 pandemic. The Malaysian capital market, like many other globally, experienced significant volatility and decline in early 2020 due to the COVID-19 pandemic. However, as the economy gradually recovered, the market has shown signs of resilience and witnessed a rebound. Government stimulus measures, accommodative monetary policies, and vaccination efforts have contributed to the recovery of the capital market. Increased retail participation. The Malaysian capital market has seen a surge in retail investor participation in recent years. This trend has been driven by factors such as greater accessibility to trading platforms, increased financial literacy, and the availability of new investment products. Retail investors have been attracted to the stock market, particularly during periods of market volatility or when there are opportunities for quick gains. Technologies and fintech innovation. The Malaysian capital market has witnessed an increasing focus on technology and fintech innovation. This includes the development of digital investment platforms, robo-advisory services, and the adoption of blockchain technology for various financial transactions. This innovation aims to enhance efficiency, accessibility, and transparency in the capital market. Sustainable and Islamic finance. Malaysia has been actively promoting sustainable finance and Islamic finance in recent years. The country has emphasized the development of environmental, social, and economic. Now we move to significant factors influencing the performance of the Malaysian capital market. The performance of the Malaysian capital market is influenced by several significant factors. It is economic conditions. The overall economic condition, both globally and domestically, have significant impact on the performance of the Malaysian capital market. Factors such as GDP growth, inflation rate, interest rate, and exchange rate can influence investor sentiment and market performance. For example, during period of robust economic growth, investors may be more willing to invest in the capital market, leading to increased demand for stocks and other securities. Conversely, economic downturn or uncertainties can dampen investor confidence and result in market downturn. Government policies and regulation. Government policies and regulation have a profound influence on the functioning and performing of the capital market. Regulatory frameworks such as securities law, listing requirement, and corporate governance standards shape the market's transparency, stability, and investor protection. The Malaysian government effort to promote a conducive investment environment, encourage foreign direct investment, and implement market-friendly policies can positively impact the capital market performance. Changes in regulation or policy shift can also have significant implications for market participants and investor confidence. Investor sentiment and confidence. Investor sentiment and confidence play a crucial role in determining the performance of the capital market. Positive sentiment and high confidence levels tend to attract more investors, leading to increased trading activity and upward price movement. Conversely, negative sentiment and low confidence can result in selling pressure and market decline. Factors such as political market, geopolitical events, global market trends, and investor perception of risk can influence investor sentiment and confidence levels. Additionally, the availability of accurate and timely information, market transparency, and investor education programs can also impact investor confidence in the capital market. It is important to note that these factors are interrelated and can have both direct and indirect effect on the performance of Malaysian capital market. Other factors such as technological advancement, foreign investor participation, corporate earnings, and sector-specific dynamics also contribute to the overall performance of the market. Derivative market in Malaysia. Definition and its primary role in financial system. The Malaysian derivative market refers to the financial market where derivative instruments are traded. Derivatives are financial contracts whose values are derived from an underlying asset index or reference rate. The Malaysian derivative market allows participants to trade a wide range of derivative products including futures, options, swaps, and forwards. The primary role of Malaysian derivative market is to provide a platform for participants to manage and hedge financial risk. Here are some key aspects of its financial role in the financial system. Risk management. Derivatives enable market participants to manage various types of risks including price volatility, interest rate fluctuation, foreign exchange exposure, and commodity price movement. Price discovery and market efficiency. The derivative market facilitates price discovery by providing a platform for buyers and sellers to trade contracts based on future expectations of underlying assets. Liquidity provision. The derivatives market plays a crucial role in providing liquidity to the financial system. By offering standardized contracts and a centralized trading platform, derivatives enhance market liquidity, allowing participants to buy or sell positions more easily. Investment and speculation. The derivative market also provides opportunities for participants to engage in investment and strategic activities. Investors can use derivative instruments to get exposure to various asset classes without directly owning the underlying asset. Portfolio diversification. Derivatives allow investors to diversify their investment portfolio by gaining exposure to different asset classes and markets. This diversification helps to spread risk and potentially enhance returns. Overall, Malaysian derivative market plays a vital role in risk management, price discovery, liquidity provision, investment opportunities, and portfolio diversification within the financial system. Various derivative instruments traded in the Malaysian market. Future contract. Future contracts are standardized agreements to buy or sell an underlying asset and determine the price on a future date. In Malaysia, future contracts are traded on various underlying assets such as stock indexes. Example, FTSE Bursa Malaysia PSL futures, commodities, and interest rate. Option contract. Option contract gives the holder the right but not the obligation to buy or sell an underlying asset at a specified price within a predetermined time frame. Options traded in Malaysia include stock option, index option, and interest rate option. Single stock future (SSF). SSF are future contracts that are based on individual stock rather than indices. SSF allow investors to take position on the future price movement of specific stock. Structured warrant. Structured warrant are derivative instruments that give the holder of the right but not the obligation to buy or sell an underlying asset at a specific price within a predetermined time frame. Structured warrants traded in Malaysia are typically issued by financial institutions and features such as leverage, a specified maturity date, and the inclusion of underlying assets such as stock, indices, and commodities. Exchange traded fund (ETF). While not strictly derivative instruments, ETFs are investment funds that are traded on stock exchange like individual stock. ETFs in Malaysia can cover exposure to various industries, sectors, or asset classes. Risk management practice associated with the Malaysian derivative market. Counterparty risk management. Counterparty risk refers to the risk that one party in a derivative transaction may report on its obligation. To manage this risk, market participants in the Malaysian derivative market often employ measures such as conducting credit assessment of counterparties, setting exposure limits, and entering into legally binding agreements such as master netting agreement and collateral agreement. These practices help to ensure that counterparties have the financial strength and ability to fulfill their obligations. Margining and collateral. Margining is a risk management practice that involves requiring market participants to maintain sufficient collateral to cover potential losses in derivative positions. Risk disclosure and reporting. Regulatory authorities in Malaysia require market participants to provide clear and comprehensive risk disclosure to investors. This includes disclosing the risks associated with derivative products, regulatory risk, potential reward, and possible losses. Risk management and monitoring. Market participants in the Malaysian derivatives market employ various risk measurement techniques to assess and monitor their exposure. This includes using sophisticated risk models, stress testing, value at risk calculation, and scenario analysis. Regulatory oversight and surveillance. Regulatory authorities in Malaysia play a crucial role in overseeing the derivatives market and implementing risk management. They establish rules and guidelines to ensure fair and transparent trading service setting practices, enforce compliance with binding requirements, monitor market activities for manipulation or abusive practice, and take action to address any potential threat to market integrity or stability. That's all for my presentation. Thank you.